Hey there, and welcome. Have you ever looked at a company's financial report and just felt completely lost? Like you're trying to read a language you've never seen before? Well, you're not wrong, but you're in the right place because today we are going to crack that code together. We're going to demystify the whole world of business finance.
So, think about it. A company can have the slickest ads, the coolest products, but how do you really know if it's successful? Is it actually making money? Is it stable, or is it about to crumble? The answers are all there in the numbers. You just have to know how to read them, and that's the mystery we're going to solve.
And this quote right here, this is the key to everything. Seriously, stop thinking of accounting as some kind of scary, complex math. It's not. It's a language. It's the universal language used to tell the financial story of any organization on the planet. And once you learn a little bit of that language, you can understand any of their stories. Okay, so if accounting is a language, what's it for? What story is it actually trying to tell us? Let's dive in.
Well, it's pretty straightforward, actually. Like any language, its whole purpose is to communicate. It takes all the chaotic stuff that happens in a business, every single sale, every purchase, every salary paid, and it translates all of that into a clear, understandable story about a company's financial health.
And telling that story happens in 4 really logical steps. First, you got to record everything that happens. Just get the raw data down. Then you classify it, grouping similar things together. After that, you summarize it all into something clean and readable, like a financial statement. And finally, the most important part, you interpret it, turning all that data into actual insights to make smart decisions.
Okay, so just like any language, you need rules, right? You need grammar. Otherwise, it's just gibberish. In accounting, these grammar rules are called concepts, and they are absolutely crucial. They make sure everyone tells their financial story truthfully and in the exact same way.
So, rule number 1, and this one is huge. The business is its own person. It is legally and financially separate from its owners. Think of it this way. The money you spend on groceries is your money, not your employer's. This concept makes sure that the owner's personal coffee runs don't get mixed up with the company's expenses. It's all about tracking the business's performance and only the business's performance. All right, rule number 2 is all about keeping things objective. And the rule is simple. If you can't put a dollar sign, or a rupee sign, or a euro sign on it, it doesn't go in the books. So things like how great your team morale is, or how brilliant your CEO is, while incredibly important, they don't get listed as an asset. We only record what can be measured in money.
Now, this next one is all about mindset. It's called the going concern concept, which is just a fancy way of saying we assume the business is going to be around for a while. It's not about to shut down tomorrow. And why is that a big deal? Well, it completely changes how you value things. A factory, for example, is valued based on its long-term ability to produce things, not on the fire sale price you'd get if you had to sell it next week.
Okay, now we get to the really cool part, the engine that makes all of this work. You've probably heard of it, the double entry system. Now, it sounds complicated, but trust me, it's actually an incredibly elegant and logical idea. It's the core action that makes this whole language function.
At its heart is this one simple, powerful idea. Every single thing a business does has a dual effect. Something comes in and something goes out. It's like Newton's third law, but for money. This is the foundation for that famous equation you see. Assets equals liabilities plus capital. The key thing to remember is those two sides always have to balance. Always. And to track those two effects, we use 2 little words that trip everyone up: debits and credits. Now, for the love of all that is holy, please forget what your bank statement says for a minute. In accounting, just think of debit as the left side of the page and credit as the right side, and that's it. As you can see here, when an asset comes in, we debit it. When an asset goes out, we credit it. Simple as that.
Let's walk through a super simple example to see this in action. The company buys a laptop for $50,000 in cash. So what just happened? 2 things. You've got to see both sides. First, an asset, the laptop, came into the business, so we debit the laptop account. At the same time, another asset, the cash, went out of the business, so we credit the cash account. And look at that, 50,000 debit, 50,000 credit. Perfectly balanced. That's the magic.
And that right there is the golden rule. It's non-negotiable. For every single transaction, the debits have to equal the credits. It's this beautiful, self-correcting system. If the books don't balance, you know instantly that you've messed up somewhere. It's brilliant.
So, we've got our language, we've got our grammar, but what happens when you want to talk to businesses in other countries? Well, just like with spoken languages, you need a shared understanding, a common dialect.
That's where global accounting standards come in.
Basically, there are two main dialects out there. In the US, they mostly use something called GAAP. Pretty much everywhere else, over 100 countries, they use IFRS. The biggest difference really comes down to philosophy. Think of GAAP as a super detailed instruction manual with a rule for everything. IFRS, on the other hand, is more like a set of guiding principles that requires more professional judgment. It's a subtle but important difference, especially when you're comparing companies from different parts of the world.
Okay, we've learned the alphabet, the grammar, and the rules. Now for the payoff. This is where we put it all together and actually read the story that accounting has been writing. And that story comes to us in what are called financial statements.
And that story usually comes in three main chapters. First, you have the profit and loss, which tells you, well, if the company made a profit or a loss over a certain time. Then there's the balance sheet. Think of it as a snapshot. On this one specific day, this is what we own and this is what we owe. And finally, the cash flow statement, which tracks the actual cash moving in and out. You absolutely need all three to get the full story.
So, let's wrap this up. What are the big takeaways? First, accounting isn't just numbers, it's the language of business. Second, it has grammar, rules like the business entity concept to keep it honest. Third, its core logic is the double entry system, that beautiful balancing act. And finally, global standards like GAAP and IFRS let us all speak the same dialect. The biggest takeaway of all? Understanding this language, it's like a superpower. It empowers you to make smarter financial decisions.
So, you now have the decoder ring. You've got the basics to start cracking the code of the financial world around you, whether it's a huge corporation or just your own personal budget. So the only question left is, now that you know the basics of the language, what business story are you going to read first?